A risk algorithm triggers a red alert. The trader on duty, Marcus Chen, stares at his screen in disbelief. A single number flashes. $600 trillion. That's not a typo. That's 10 times the entire global economy, all tied up in financial contracts that most people have never heard of. They're called derivatives. And in the next 48 hours, a small pension fund in Omaha, Nebraska, will accidentally trigger a chain reaction that could vaporize the wealth of nations. Marcus picks up his phone to call his supervisor. It's dead. The entire communication system down. Across the trading floor, every screen simultaneously displays the same message. Counterparty default detected. Cascade protocol initiated. Marcus whispers one word. No. Because he knows what comes next, and you should too. Susan Martinez, 58, manages a small municipal pension fund for the city's firefighters and teachers. $340 million under management. 847 retirees depending on it. People like Tom Brennan, who fought fires for 32 years and now lives on $2,800 a month. Susan's fund has been struggling. Returns are down, costs are up. So when Christopher Wade, a smooth-talking derivatives broker from Goldman Sachs, pitched her a safe, guaranteed return strategy, she listened. It's called an interest rate swap, he explained. You'll lock in higher returns while protecting against rate changes. Major pension funds do it all the time. The contract was 47 pages of dense financial jargon. She signed on page 46. Meanwhile, in a glass tower in Chicago, Dr. Rebecca Torres, Chief Risk Officer at Midwest Financial Holdings, reviews her bank's exposure to derivatives. The spreadsheet shows total derivatives exposure, $89 billion cash reserves, $4.2 billion. She runs a stress test simulation. What happens if interest rates spike and 3 major counterparties default? The model crashes her computer. When it reboots, one line appears, scenario exceeds modeling parameters, bank failure probability 94.7%. Rebecca deletes the report. She would regret that decision in exactly 71 hours. The warnings were invisible to everyone except a few who knew where to look. December 2024. A small Italian bank misses a derivatives payment, covered up quietly. Credit default swap spreads on major banks tick upward. The VIX volatility index jumps unexpectedly, then settles. January 2025. A hedge fund in Connecticut quietly liquidates its entire derivatives portfolio. 3 major banks request emergency liquidity from the Fed, unreported. An obscure financial blog posts. The derivatives time bomb just started ticking. Nobody reads it. Susan's pension fund receives an email from Goldman Sachs. Interest rate environment update. Margin call potential advisory. She doesn't understand it. She files it away. That email was a warning. In 68 hours, it would become a death sentence. Deep in the Federal Reserve Building, Washington, D.C., an emergency meeting convenes. Fed Governor Patricia Holmes presents a classified report. The derivatives market has grown to $600 trillion notional value. Most are interest rate swaps and credit default swaps, essentially bets on bets. Our concern, the entire system is built on counterparty trust. If one major bank fails to pay, she doesn't finish the sentence. Someone asks, how much of this is insured? That's the problem. The insurance, credit default swaps, are themselves derivatives. It's a snake eating its own tail. And if the snake chokes? Tom Brennan, the retired firefighter, sits in his small apartment in Lincoln, Nebraska, watching Wheel of Fortune. He doesn't know that his pension is collateral in a derivatives chain stretching through Goldman Sachs, New York, Deutsche Bank, Frankfurt, a hedge fund in the Cayman Islands, a Japanese insurance company, and 12 other entities. If any one of them fails, the chain breaks, and Tom's $2,800 month vanishes. Question hanging in the air. How can something he's never heard of destroy everything he's worked for? The Fed announces a liquidity support program to calm markets. Banks breathe easier. Susan gets an email. Recent volatility addressed. Your investments remain secure. She smiles with relief. Rebecca sees the Fed announcement and thinks maybe we dodged the bullet. But in a basement server room in New Jersey, an automated clearing system is processing millions of derivatives contracts. One contract, Susan's interest rate swap, hits a trigger point. Interest rates spiked 0.3% overnight. The algorithm automatically issues a margin call. Susan's fund must deposit $37 million within 24 hours or default. $37 million the fund doesn't have. Countdown begins, 24 hours until default. 18 hours until Rebecca's bank, the counterparty, gets hit with a $2.1 billion claim. 12 hours until the cascade begins. Nobody knows yet. The system is designed to hide problems until they explode. The villain isn't a person. It's systemic greed disguised as innovation. In the 1990s, derivatives were sold as risk management tools. Banks could hedge bets. Insurance companies could protect investments. Pension funds could boost returns. But the market metastasized. Derivatives on derivatives. Bets on whether other bets would fail. Leverage stacked on leverage. By 2025, for every $1 in actual assets, there's $50 in derivative contracts betting on what might happen to that dollar. Christopher Wade, the Goldman Sachs broker who sold Susan the swap, faces his own dilemma. He gets a call from his boss. The Omaha pension fund is going to default. We need to close that position before it triggers our exposure clause. How? Convince them to sell at a loss. Get them to sign the exit agreement, whatever it takes. Christopher knows if Susan exits now, the fund loses $12 million immediately, but survives. If she doesn't, the fund could be wiped out entirely. But if he tells her the truth, he loses his $400,000 bonus. He picks up the phone. What will he choose? Rebecca finally gets the full picture when an internal auditor walks into her office. Pale, shaking. "Mom, I found something in our derivatives book." He shows her a hidden tab in the spreadsheet, CDS obligations, credit default swaps, the insurance that supposedly protects against defaults. Rebecca's bank sold $47 billion worth of these insurance policies to other institutions. So we collect premiums, that's good, right? "Ma'am, if there's a wave of defaults, we'd have to pay out $47 billion. We have reserves for that." "No, Mum, we have $4.2 billion. The rest. We assumed defaults wouldn't happen simultaneously." Rebecca's stomach drops. How many institutions did we insure? 274, including the Omaha Firefighters Pension Fund. The insurance meant to protect the system is the weapon that will destroy it. When Susan's fund defaults, it triggers insurance claims. When Rebecca's bank can't pay those claims, those defaults trigger more insurance claims. It's not a chain reaction, it's a nuclear reaction. And Marcus Chen, the trader in New York, just discovered something even worse. Susan arrives at work to find her email flooded with margin calls, legal notices and urgent warnings. She calls Goldman Sachs. Christopher Wade answers, "Susan, we need to talk about your position." By 9 a.m., Susan's fund defaults. Goldman Sachs declares a counterparty event Midwest Financial Holdings. Rebecca's bank gets hit with $2.1 billion in claims. Rebecca's bank fails to pay. The clearing system flags a systemic counterparty failure. By 11 a.m., the Deutsche Bank, which insured Rebecca's bank, faces $18 billion in claims. 3 hedge funds collapse. Trading halts on major exchanges by 2 p.m. Tom Brennan checks his pension account online. Balance. He calls the pension office. Line is busy. He turns on the news. Breaking global derivatives crisis. Banks suspend withdrawals. Tom sits down heavily. 32 years of service. Gone. Across America, a teacher in Portland loses her retirement. A factory worker in Detroit can't access his 401k. A widow in Miami sees her late husband's life insurance policy frozen. The contagion spreads. London banks close. Tokyo markets plunge. The euro shudders, all because of a market most people didn't know existed. Marcus Chen finally gets through to the Federal Reserve. "You need to see this," he tells them. He's discovered something in the derivatives clearing data. Major banks have been using an accounting loophole to hide their true exposure. It's called netting. Banks report only the net difference between what they owe and what they're owed. Example, bank owes $100 billion in derivatives. Bank is owed $98 billion. They report only $2 billion exposure. Sounds smart, right? Wrong. Because when the counterparties who owe them $98 billion can't pay, the bank suddenly owes the full $100 billion with only $2 billion in reserves. Marcus shows the Fed the real numbers. JP Morgan Chase, $50 trillion gross exposure. Bank of America, $38 trillion gross exposure. Citigroup, $44 trillion gross exposure. Total global banking exposure, $600+ trillion actual global reserves to cover it. $8 trillion, the ratio 75 to 1:1. Fed official whispers, this isn't a crisis, this is extinction level for the financial system. The 2008 crisis, that was derivatives too, $600 billion worth. This is 1,000 times larger, and this time, governments don't have the resources to bail anyone out. January 10th, 2025. Emergency measures deployed. Trading suspended globally for 72 hours. Central banks inject $10 trillion in emergency liquidity. Derivatives contracts temporarily frozen. Congress passes emergency legislation. But the damage is done. Tom Brennan's pension? Cut by 60%. Susan Martinez? Under investigation for negligent fund management, even though she was sold a product she never understood. Rebecca Torres? Testifying before Congress, explaining how her bank hid $89 billion in exposure. Christopher Wade? Quietly resigned, bonus paid before the collapse. The banks? Too big to fail. Again. Bailed out. Again. By taxpayers who never knew the risk existed. The $600 trillion derivatives market isn't theoretical. It's real. It's growing. And it's completely unregulated. Right now, your pension, your 401k, your bank deposits, they're all collateral in a system of bets you never agreed to. When someone asks, how could the economy collapse overnight? This is how. Not through war or natural disaster, through financial weapons of mass destruction, hidden in plain sight labeled sophisticated risk management. If this terrifies you, it should. Because every expert who warned about this before 2012 was ignored. And the market has grown 10 times larger since then. Subscribe to understand the economic forces that control your future before they destroy it. Comment below. Should derivatives be illegal, regulated, or left alone? Explain your answer. And ask yourself, if 847 firefighters and teachers in Omaha can lose everything in 48 hours because of contracts they never signed, what's stopping it from happening to you?